Depending on what market you were in the global financial crisis, stocks fell somewhere between 50 to 65%. Now, I got my clients out early in '08 before there was a Bear Stearns or a Lehman Brothers or any of that. Okay, here's the thing. It scared them at first because no one else was doing it. And then we stayed out for the rest of '08. But throughout '08, they kept saying like, well, now let's do something more. Let's do something more. And more, I feel people feeling like something's got to happen, like they're getting tired of the sidewaysness. We have to talk what's going on internally within the markets and also look at the last time the yield curve was this bad. Stick around. Hey everybody, this is RC Peck with Fearless Wealth, and this is my weekly video on what I think is most important to make sure that you retire strong, or you are going into a strong retirement so you do not have to worry and you have the assurance that everything is going to be okay, right? Sure, you can look at the market, sure, you can dabble in it, but you know, when your active income stops, that's the most important performance of your life. Literally, the best performance of your portfolio has to be when all of the active income stops. Now, there's three things I want to talk with you about today. I want to talk about the inverted yield curve, what it means, why it's important, why people are talking about it, what it means to your retirement. I want to talk about Jamie Dimon and him coming out saying, we ought to ban short sellers. They should be put in jail. They should be prosecuted. Oh, okay, so we'll get to that. I don't want to start my rant right now. And then let's look at some internals of the market and really understand, is the market getting stronger? Is the market getting weaker? What's going on? So here we go. Let's get over to the charts. Now, here's the first chart I want to show you. Now, there's two charts on the screen. The top chart is the yield. So follow me here. You take the yield on the 10-year and you subtract the yield on the 3-month, right? So if the yield on the 3-month is yielding more, the line on the top chart goes below 0. Now, 0 is the black, thick horizontal line. So your brain can see that this yield curve, right, the 3-10 or the 10-3, it went negative, or what's called inverted, in 2000, in 2006, and in 2019, and again today. So let's just talk a little bit about this. So the first thing I really want you to notice is once the yield curve goes inverted, that doesn't mean much. It doesn't mean much once it goes inverted, right? So it goes inverted. The real pain happens when it's what's called steepens, right? When the curve steepens, that's this right there. That's when really bad stuff happens to the stock market. Now, this whole yellow section here, that is the 50% drop in the S&P. The S&P is the bottom chart. So that's the entire drop. And you can see on the top chart, the yield curve at first went inverted. And yes, the S&P started falling in the second half of 2000. And then it just continued accelerating to the downside as the yield curve steepened. So it's not really the inversion, it's really the steepening that's the problem. Now let's fast forward to 2006. So here, 2006 here, the yield curve inverts, but then it steepens, which means it uninverts. You can see it uninvert. And then the stock market this time around fell 55%, right? So the big fall happened entirely after the yield curve started to steepen, where in the 2000.com, you got a little bit of a fall, maybe 10% of the 50+% fall in the stock market. But the majority of the stock market falling in the 2000.com was after the yield curve inverted. The other thing I want to point out to you is 2001 was a mild recession. A mild recession. The NASDAQ fell 83% and the S&P fell 50%. And then let's fast forward to 2019. The yield curve inverts, and then it uninverts or steepens, and then you get the whole COVID thing. Personally, I think there was a recession coming before the whole COVID flash crash thingy and tens of trillions were printed collectively. But now we are back there. So the yield started falling, the yield curve started falling, and it inverted in November of last year, and it is really, really negative. Now, here's the interesting thing. The S&P has already fallen 25%, and then it's corrected about 15%. It's still down about, I'm just going from memory here, 17%? And the yield curve hasn't even started steepening yet. So the bad stuff is yet to come. Yes, it's inverted, but again, the inversion is not the problem. It's when it starts to steepen. So that's the first thing I wanted to show you there, because a lot of these terms get thrown around like, oh, it's not happening this time, or it's not this, or it's not that. And people are just not clear. When it steepens is when bad stuff happens. The fact that the market's already fallen 25% with a correction, typically not a good sign. Okay, the next thing is I wanted to show you a couple indicators that can kind of give us an idea of where the market is. So let me go up here and just start with this one right here. So this is common stock only new highs. So how much, this is on the New York Stock Exchange, only looking at stocks only. Okay, so how much, are stocks making new highs? Not that many, only about 24 are making new highs. That's not that good. It's not horrible, it's not below the line, but it's just not really giving us. So it's kind of, let's call it a neutral indicator. Okay, then on the New York Stock Exchange, let's just see if there's any new lows happening. And again, we're not really seeing a lot. So there's not a lot of new highs and there's not a lot of new lows. So those two don't tell us much. And I purposely wanted to show you two that were ambiguous. Now let's get to this chart. Now this chart is simply saying what percentage of stocks on the S&P percentage are above their 200-day moving average. And the answer is about 48%. I don't have my glasses, I'm gonna have to squint. That looks about 48.6. So we can even round it and call it 50%. So about 50% of stocks in the S&P are above their 200-day moving average. Okay, so that one piece of data is good to know. Here's the thing. How many stocks are above their 200-day moving average? It peaked in January of this year. It was 75% of stocks in the S&P were above their 200-day moving average. That's been cut by a third. Now it's only down to a little less than 50%. So even though the price of the S&P is right back to where it was in that February, there's a third less stocks that are above their 200-day moving average. So that is definitely not good. So we have two neutrals and one bearish indicator. This is how many stocks in the S&P are above their 50-day moving average. Now we're going to see a similar type of divergence here. Back in November of last year, right at the very back end of November, we had about 90, gosh, I have to look to see what that is, 90% of stocks in the S&P, 90% of stocks in the S&P were above their 50-day. But look down here, that didn't get us that high. They were above their 50, all right? That didn't make a new higher high. It made a lower high from the previous high. So then we moved to January of 2023, the beginning of this year. And yeah, there's less stocks above their 50-day moving average. And then we moved to kind of just the price is a little bit below where it was in February. And now there's only 47% of stocks above their 50 days. So that's called a bearish divergence, right? The internals are looking bearish, even though stock market's gone kind of flat. Fewer and fewer stocks are moving up. Okay, let's show two more. This is the advanced decline line. So this is on the New York Stock Exchange too. And it's basically saying how many stocks are advancing and how many stocks are declining. Now I know there's two charts on every screen, but the top chart's always the indicator. The bottom one is the S&P. So what I want to show you here is there's the top chart to my brain. What I see the most is a downtrend that has not stopped, right? So I'm looking at the advanced decline line and it just is still, let's just make it red, make it easier to see. So the advanced decline line is still declining. The highs are getting lower over time. That's bearish, that's not good. And the same thing with the previous indicator actually the previous two indicators, percentage stocks over the 50-day and the percent of stocks over the 200-day, this indicator is getting more bearish as the stock market is staying flat. So again, all I'm doing is looking at internals and just kind of being like, well, what are the internals telling us? Like, what are they telling us? And then lastly, and then I'll get to one more chart, this is just simply showing us how many stocks are in an uptrend and how many stocks are in a downtrend. If it's above 7, if it's above this top black line right here, that typically is getting us to the end of a bigger move. Doesn't mean the market's falling, just, markets moving cosine waves up and down and sideways. And if it's below the bottom line, it means the stock market's getting to the bottom of that shorter term move. What I want to show you again on this is the highs are getting lower, and the highs are getting lower since August of last year. So even though the market has gone up, a lot of the internals are weakening, right? And we can look at those by looking at the percentage of stocks moving up and moving down, how many are moving up, how many above their 200, and so on. And most of those at best are neutral, and most of them are bearish. Okay, so here's the last chart I want to show you. Jamie Dimon, the CEO of JPMorgan, came out and said people who short banking stocks and then go and tweet about it should basically face criminal law. He's making it seem like it's illegal to do that. So first of all, short selling is not. That's the first thing. I believe Jamie Dimon's lieutenants go on CNBC and MSNBC and Fox and all the other channels and talk their book up and talk about how great the banks are that they own. That's allowed. And so he's starting to talk about banning short selling. So 2008, guess what? Short selling was banned by the SEC. If you look on the screen, it was stopped. Short selling was not allowed on September 18th, 2008. Now, if you're remembering, Lehman Brothers collapsed on the 15th, September 15th, and a few days later, banning was shorted on financial stock. Sorry, there was a ban on shorting financial stocks. That is not a good thing to do. That means things are really, really bad. The last time a major ban happened was 2008, and the S&P and the NASDAQ fell, wait for it, 40% more. So if we do get a ban, that means stuff is really bad. It's much worse than you even think it is. So let's put this all together. You don't always have to be doing something. We are moving into a period where there's actually more risk. Whether you look at the inverted yield curve, whether you look at what happens when the Fed tightens, whether you look at what the current PE ratio is of the S&P, it ain't cheap. Whether you look at the yield on the 1-year treasury or the 6-month treasury, basically you can get half of the long-term average growth of the S&P for free. So the long-term growth of the S&P is somewhere between 9 and 10%. Today you can basically get 5% on treasuries. You can get half of that for free, zero risk. That's pretty amazing. The PE ratio on the S&P is about 20. If you invert that, you get the stock yield or the PE yield, which is about 5. So the market is yielding about 5 if you invert the PE ratio, and treasuries are paying about 5. One is completely risk-free and without any volatility, and the other one has a lot of volatility. That's where we are, and that's where we are moving into more and more. We're moving into a period of more volatility, not less, when we have, again, an inverted yield curve. Not good. After inverted yield curves, they get inverted, they steepen. That's really not good for the market, as in not good. The last 11, I have to think about this from memory. The last 11 inverted yield curves, 11, all led to recessions. And I said it before in the video, but I just want to say it again. 2001 was a mild recession. It was a mild recession. NASDAQ fell 83%, the S&P fell 50%, international fell somewhere between those two. So whether we get a mild or a medium or a large recession, that's almost separate from what the market itself is going to do. But the big takeaway is we continue to move into a period of more instability and not less. And yes, I get the biggest 8 stocks right now in the stock market. They're all crushing it. I get that. I'm not saying go put your head in the sand. I'm saying you want to have more of a defensive posture and look for opportunities and look for things that don't come along that often, because there's a lot of them happening. Thanks everyone for being in my world. I appreciate you watching this video. I appreciate you liking it and subscribing. All of those things help. Leave a comment. I respond to all my comments. If you find yourself curious about why you're still in a 60-40 or a 70-30 or an 80-20 portfolio, which by the way, 95% of retired people are, the history is not on your side as far as how well it will treat you in the 2020s. We do portfolio x-rays. They are amazing in what people learn about their own portfolios. And I just don't know what you'd like most about it. How clear it is we talk about what is actually best for your retirement, or just the glaring holes in your portfolio from kind of these relic 1950 approaches. But whichever one it is, you'll really see it because we use your own portfolio and we talk to you about where your holes are and how you can fix them. Anyway, you can do that. You can go below in the description and get a portfolio x-ray set up. Thanks again, everyone, for being in my world, and I will see you on my next video. Okay, bye.